Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guy TV. Just want to let you know that if you are in the Tradier hub and you log in, you do have to actually create a login. You can participate in the reindeer games. If you'd like, you can ask questions inside the chat box. I forget to tell you that every once in a while, so I thought I'd do it right off the start. And then also inside the YouTube platform for Tradier, if you are logged into your YouTube profile, you can actually ask questions inside that platform. So, well, we had a lot of success last week with the VIX. The VIX is coming off a little bit on the market. So I'm actually out of my VIX trade. I actually closed it out on the open this morning. And the VIX right now is at 2098. It's down $1.40 on the day. And that's just as of recent. The markets are wanting to go higher, but they're just really struggling to do so. So we got the Russell 2000 index up 0.5%. We have the S&P 500 index also up about 0.5%, but it was up higher in the day. Now it's came off a little bit. And interesting just tidbit about the jobs numbers last week. So let's stay here in this view. I'm going to pull up just some numbers and look at some things. So in the Fed, the CME Fed Watch tool, after the jobs numbers, what we saw was the probability of a 50 basis point cut in the Fed funds go down. So 1 month ago, the possibility of a 50 basis points cut. Now, remember, it's highly anticipated that they're going to cut at least 1/4 point. But the numbers on the 50 basis point cut have really fluctuated. So 1 month ago, on the August 9th futures were implying a 50% chance of a 50 basis point cut. A week ago, it was at a 30% chance. And now it came down to about a 27% chance of a rate cut in a 50 basis point rate cut. So the numbers spooked the market a little bit, but other things that came in line is that for a moment there, we became inverted on the 10 and the 2 yield curve. In other words, the 2 was trading higher on a yield basis than the 10. That's came back in line. The 2-year yield right now is 3.57, and the 10-year is 3.70. So the yield curve has came back in line. The market is less scared, if you will, and thinking that we need a 50 basis point rate cut. That's came all the way down to 30. So the market's taken the job news pretty well, except for the fact that the market has tanked, right? You're looking at the bond market and the probability of a 50 basis point rate cut. If you looked at just those things, you would think that the market would be doing well. But then again, we got the seasonality, and it seems like any news that is not good news in September and October really seems to hurt the markets. Okay. So we've been bearish, and we said we wanted to get bearish in September. And we started by doing a bullish trade in the SPX, and we did a couple of different trades in the VIX, a bullish trade in the VIX, and that is the inverse of the SPX, right? So if the SPX goes down, the VIX usually goes up. They call it the fear index for a reason. And the VIX is staying strong right at that 20 level, even though we have a decent up day today. And it'd be interesting to see if these numbers hold and we actually have a positive day on a Monday in September. I wouldn't want to try to just play the upside on today's market. It still feels a little iffy, if you will. So we have a bearish trade on, and we put it on Friday, and it was a modified put butterfly. So I'm going to start with that trade today, and let's pull it up and see where we're at. We paid $2.25 for that trade, and it's going to be down because we're up 0.5%. SPX is up 33 right now, and just before the show it was up 60, so it's been cut in half, the gains in the S&P 500 index. We used the Friday the 13th, the spooky expiration, which is this Friday. The market when this trade was entered, it was at 54.33. Okay, so we're at 54.41. Trying to grab it at there. Well, 54.41.66. So we're up about, let's call it 10 points. Okay, 9 points. And here's the trade. We went on the put side of things and we were bearish. We did the 54.15, bought this option contract, sold the 5400. We like that nice round number as our target. So right here. And then we stopped short instead of doing a full regular butterfly. And we bought the 5390s. All right, so we put this trade on for $2.25, and we now see that the trade is trading for $1.95. So we're down 25 cents on the trade, and the market is up 0.5%. Interesting, just interesting to note, to get a good feel. Like if you do a lot of butterflies, you get a solid feel. The pricing in the SPX stays pretty steady, especially if the implied volatility remains where it's at, right around that 20% level. This is going to hold its value. This butterfly is. Now, here's the adjustment, and I mentioned that in the description today. If you wanted to, and I'm not going to do it today because we're only down 25 cents, and I still kind of feel bearish about the market. I'll be surprised if we end up at the end of the day, but I just don't expect a lot to go on in the marketplace at this point in time. Everything, we're going to start focusing on that Fed date, which is September 18th. A little bit of a choppy marketplace is what I anticipate going into that number. 54.15, what you can do, and you see all of how much premium is still in these option contracts with 4 days remaining. The at-the-money option is at 46. The put option that we bought to start was at 35. We'd like the market to come down, still land within our range, hang right around that 5,400 level. And if you want to adjust this trade, so there's two ways that you can do it, okay? We paid $2.25 for it. And if I were to adjust it today, what I would do is sell the 54.15 and buy one of the 5400s. Now, there are two different adjustments you can make. If it gets too far away from you, you can roll into by selling this option. Did I say buy? We're going to sell this option contract and then buy one of the cheapest ones, the 5390. But that leaves you with two short put spreads. Here in this instance, we're going to sell this option contract and buy this one back, right? We're still going to bring in a solid net credit to the account, but then that leaves us with one short put spread that is 10 points wide, or $1,000 in that instance. All right. So here's my adjustment. Let me emphasize that I wouldn't want to adjust this trade right now. The market it hasn't gotten away from us, down a quarter on the trade. If it ended up 1.5% today up, so another, let's say 60 points to the upside, then I would probably make an adjustment on the day today. But right now, I don't necessarily think there's a need. But I want you to know what a simple adjustment is on this trade. So here's the simple adjustment. If the market hangs around here and you feel like it's going to be bullish and you don't want to play it out, let it ride, if you will, then here's the adjustment. Okay, so 53.90. So we're gonna get rid of this. We're going to be buying to close. I'm going to hit open here, but we're going to hit buying to close that option contract. We're not going to deal with this one at all. And we are going to then sell to close. I have to click open because it's just a setup account. And we're bringing in $4.95. Now, I'm going to grab my screenshot here, if I can get this to work, and show you where we were at. We were at $2.25 for a net debit to the account. So let me grab it, pull it up a little bit. This is the screen grab from Friday's show. This is the trade that we put on. This is where the SPX was at, 54.33. We bought this modified butterfly for $2.25. It's modified because the long spread is 15 points on the put side of things, and the short spread is 10 points. That meant we increased our cost a little bit, but it gave us this nice little shelf above the zero line. If the market did completely tank and go down below 53.90, we could still be profitable on that trade. Okay, it's a real nice situation. Now, we panic. Oh my gosh, the market went up today. It's Monday and it's up. Okay, now what are we going to do? Well, now you could sell this if you turn bullish on the market and bring in $5. We paid $2.25. We're bringing in, let's put it right at 5, so the math is simple, if we can get a midpoint fill. And we bring in a net credit of $5 to the account. That means we're up, we have a net credit total. We paid $2.25 for the initial butterfly. We bring in a credit of $5, and that means we have a net credit of $2.75 on the entire trade. And we need the market to stay above 5,400, and it's at 54.36 right now. So you're talking about 0.5% before it comes back and gets to that strike. That is an adjustment. I think I would wait. If you waited, and let's say the market went up another 1% today, and it would have been, so it would be up about 90 points at this point in time. This credit that we're looking to do on this trade might be $1 or maybe $2. So it might be about what we paid for the butterfly, right? You could say to yourself, well, if this credit gets down to $3, then I'll make this adjustment and literally just base it off of the credit. Because if it gets to $3, that means the market has gone up. Hang with me here, but the market has gone up, but I can still make this adjustment. And if my short put spread works out, I can still be profitable on the trade. Now, we're just dealing with one butterfly. So it's a 1x2x1 to start. If you do that adjustment, you would bring in, let's say this market went up. This was actually trading for $3. Net credit of 75 cents on the gaggle of option contracts that we just traded. And we would have a $1,000 requirement and a 75-cent net credit to the account. That means our total risk then would be $9.25. And then you have until the 13th, 4 more days, and these stop trading at the close on Friday. So you have all day Friday on this position too. And that would be the adjustment. That's how you could watch it. Now, the other adjustment, if we look at this trade, okay, so let's go back, is going to add more risk, but it allows you to wait a little longer to make an adjustment. So in this instance, the adjustment would be, you're not going to worry about the middle strike and buying it back. You'd still be selling the 54.15. We're still going to sell the most expensive option contract. But instead of buying the 5400s, we would buy the 5390s, which is the other leg of our trade. And you see right now that's trading for a net credit of $8.30. But you now end up with two credit spreads that are 1,000 points wide, or a margin requirement of $2,000, and that your max risk would be $2,000 minus whatever net credit you brought in. But you see the credit is higher, so you could let the market run more, and if it ran more, you can roll the dice, if you will, and say, okay, now the market's up 2% from when we started, or maybe 2.5%. I can still get this done for a decent net credit to the account, and I'm in this short put spread, and it's still, now it's got a farther way, it's got more, so now you'd be farther away from your short put strike. I don't know why I struggled so much saying that. Farther away from your short put strike, because the market just ran up, right? You would still have that same 5,400, 5390 short spread. You just would have two of them. There you go, the two adjustments that you can make. If you have any comments or questions, I tried to go through it methodically, but that is kind of a tough concept. And obviously you can go back and rewind this inside the Tradier Hub if you'd like, and see exactly how we would do this adjustment. So I like personally not waiting for the market to get too far away from me and rolling into the one short put spread, because I don't mind a short put spread risk. Now, in my account, I would probably have a 10 lot or a 5 lot at least of this trade. I always talk about the 1 lot here on Options Guy TV. Try to make things as simple and straightforward as possible. And if you are going to start trading options, obviously start with the smaller size and work up towards a bigger size. If you can make, if you can't make money on a small size, well, you're not going to make money on a big size, and that's just the way it is. That's the good old lesson of option trading for many years. Okay, so we're back to the here. If there's no questions, we got one question here. We don't have a question. We have a typo is what we have from what I see from Tim. So with that said, let's look at a trade in Nvidia. And all I'm going to do to Nvidia, I'm kind of thinking a dead cat bounce, for lack of a, even if you drop a dead cat off a roof, when it hits the ground, it's going to bounce at least once, right? So they use that in the stock market as a term to say that if Nvidia is down about 11%, now it's back up about, I think it came down 11 or 12% from its most recent high, and now it's up 1.4%. I'm going to sell some premium, mainly because I think it's really hard for Nvidia to get below the 100 level. We did recently in August run down to below 100, but we just stayed there for a fraction of the day, and it closed up above 100. So I want to sell a short-term put spread, like a totally speculative trade, thinking that Nvidia isn't going to break through the 100 level. We're going to bring in a net credit. We're not going to have a ton of risk on this trade, but we're going to sell the 98 strike put, which is obviously 2 points below the 100 level. We're going to sell that, and then we're going to go down 3 points, and we're going to buy the 95 strike put. Now, that was trading for 50 cents before the show, and now it's 48 cents. I like 50 cents better. But don't mind this at 42 cents. And this is going to be the paper trade for this week that we're going to look at. We're going to be selling a short put, just selling volatility in Nvidia. The historical vol is around 55%, and you see here that this vol is trading at 65%. So we're going to sell some of that premium, and that's exactly what we did here. We sold a 98 strike put, hoping that the market doesn't come down to 98, and if it does, well, we might adjust the trade, right? We got a short-term window here to be able to adjust the trade, but if it does come down to 98. At that point in time, our risk kicks in, and from 98 to 95, we are short a put spread, and we have risk of 3 points minus the net credit of 40 cents. We'll call it 40 cents. There it is right there, which is $2.60 on this trade. And I'll send this into the what if calculator so that you can get a visual perspective of it. And we'll pull that down, and there we are. And that's what the short put spread. The last trade was at 104. 98 is where our risk is, down to 95, limited and known risk. So it's showing you right there that 260 is basically what you could lose on that trade. And it's based off of where that midpoint is at right now. All right. So I think I have a few more minutes. Here's what I'm going to do, because I know everything that I explained inside the SPX trade is confusing. So let's go in and back out here for a second. There we go. And let's pull up the options playbook. And give me a second here to get situated. Long put spread. Okay, so on a short put spread, if you look at just a long butterfly with puts, here's what we did. We modified this. We bought strike C, sold 2 puts at strike A, and then bought another put. I'm sorry, 2 puts at strike B, and then bought another put at strike A. So down here in this range. But instead of this put being the same distance away as this one, we did it. We stopped short. We bought this put right in here. It added some cost, but it moved this entire leg up to where this is where our profit and loss graph is at right now. Okay, so that was our first modification. And that gave us, if we got that huge move to the downside, more than a 1 standard deviation move to the downside, we'd still be profitable on the trade. We had to pay a little bit up for it, but that's okay. I don't mind that, to have that potential if the market runs all the way down, that we're still good on the trade. Could still hit a home run if we land somewhere around the B strike, right in that area. Still a little bit bearish on the market. Okay, so the short put spread, which is this trade right here, and we got the graphics going on here. Let me just stop that. So what we're saying is that the short put spread is not as wide as the long put spread. So if you combine, and you can see this, if you sell this put spread and you combine this put spread, you end up with a profit and loss graph that looks like this. That simple, right? That one combined with this one makes this one. Now, if that is the case, right, where we have these two trades, all we're going to end up doing is removing basically this long put spread. We're going to sell this strike and buy this strike right in this range. Sell this. This was a long put, and buy this. And if we remove that, and we wouldn't be profitable for us to move it, right? Because the market went against us. But if we do that, we just end up with this. I try to say these things in as many different ways as I possibly can, but that's all the adjustment is. You take your butterfly, and remember, this is a little shorter than this leg. That's fine, but we take the butterfly, and we look at the guts of the butterfly. The guts of the butterfly say we're short a put spread, we're long a put spread, and the market is now going against us. So we say, all right, let's just make this a short put spread, and we'll sell the thing that still has some value, which is the long put spread. And then we end up with a short put spread for not as good of a net credit as if we initially put it on, but we still do it for a net credit to the account. And you're saying to yourself, I don't want the cheese anymore. Just let me out of the trap. Market was supposed to go down. It didn't. And now I'm going to adjust my trade, and I'm going to make one adjustment on the trade. And if it does go against me and comes down and hits my short strike again, I'm just going to get out. I'm just going to close out the trade and move on. Say, okay, I was bearish to start. The marketplace didn't agree with me. The marketplace went up. All right, that's fine, but I will try to join you now, marketplace. Oh, and now all of a sudden you changed your mind again and you went back down. Okay, now I'm out. So I'm giving myself 2 opportunities to be profitable on this trade. And I like to do it when you're bearish. It works better on the put side of things just because of the way, and I don't want to get into that much detail, but just the skew of the option contracts. It helps out in this scenario in general. So if I'm bearish on the marketplace, which September and October just seasonality has a lot to do with it. Big event coming out in November, which we just need to get rid of for the marketplace to function normally. But the presidential election, there's always a lot of chop in the marketplace heading into it, and then usually the markets settle down afterwards. So with that said, I guess that's it. Let's come back out. If you have any questions, feel free to put them in the chat box. I'm going to give you a couple of moments. So here's what we accomplished today. On Friday, we put on a bearish SPX trade. Now, over the last couple of weeks, well, I shouldn't say a couple of weeks. So over the last week, we were bearish on the market, and we took advantage of it by doing VIX options and trading the VIX and adjusting those trades. And we've done pretty well with all the VIX trades that were put on over the last couple of weeks of shows. If you want to go back and check them out, feel free. This one we were not. So far, you know, we're in the red. We're not making money on this trade, but you learn so much more from trades that don't play out here on a show like Options Guide TV than on trades that do. We looked at the adjustment. I'm not saying I would adjust today. I would prefer to wait until tomorrow at least. Hopefully the markets kind of stay at this level, or even Wednesday would be a great day to adjust, because if we do the adjustment, we're adding risk, right? Right now, our total risk is $2.25. If we adjust the trade, we're going to add $1,000 margin requirement on the first adjustment we talked about today, or a $2,000 margin requirement on the second adjustment. But it's all based off of how much net credit you would bring in as to your total risk to the trade. Then we just looked at we're just going to do the dead cat bounce trade in Nvidia. Obviously good stock. Earnings have still been extremely solid across the board. Last 3, 4, 5 quarters, the growth is amazing. And so we're just hoping this week that we just get that bounce in Nvidia, and it can't break below that 100 level. Very speculative trade. I don't mind putting that one on today. And that's it for this edition of Options Guide TV. We will come back on Wednesday. We'll look at both of our trades and see where we're at. And then look if we need to make any adjustments to the Nvidia side of things. And I'll let you know through Twitter, or otherwise known as, well, I should say x.com, otherwise known as Twitter, with the handle at my name, at Brian Overby. And if I make an adjustment tomorrow on the SPX trade, I will let you know about it. Thanks for coming, everyone. And we will see you on Wednesday, 11 a.m. Eastern time, for the next edition of Options Guide TV.
Capitalize on stock market uncertainty this coming election. When most see disaster in the headlines, informed traders see dollar signs. Elite traders have embraced market fear for decades, and now you can too. Join us at our exclusive Fall Tradier Virtual Summit, sponsored by SIBO, on Wednesday, September 18th, 2024 at 10:30 a.m. Eastern Time. Claim your seat at summit.tradier.com before registration closes.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.